Hello everyone, welcome to my class. In today's lecture, I will be discussing on IAS 37 provisions, contingent liabilities and contingent assets. This lecture will be beneficial to both students who are attempting SPR or FR paper. So now let's begin with the standard. I need all of yours concentration. So what is provision? A provision is a liability of uncertain timing or amount. You got that? It is the liability, obligation, but it has no certain timing as to when the entity has to pay or certain amount as to which amount it has to pay in near future. But it is a present obligation that it has to pay, but no certain timing or amount. Okay, it is certain that it has to pay, but it does not have a certain timing or amount. That is defined as provision. So can you spot the differences between liability and provision? Liability is an obligation with certain timing or amount. At what time that the entity will have to pay certain amount, and at which amount. That in the case of liability, it is certain, but in the case of provision, it is uncertain that at which time the entity has to pay or at which amount. Okay, so now see the criteria for the recognition of provision. There are three criteria as shown in this screen. Let's read it out. First one is an entity has a present obligation arising from past event. That is the same as the definition of liability. I hope you guys can understand this well. So the second is it is probable that there will be an outflow of economic benefit. So see here, it is probable, it is not virtually certain. Okay, in case of liability, it is virtually certain that there will be an outflow of economic benefit. But in case of provision, it is probable, not virtually certain. It is not sure. Okay, virtually certain means it is not sure, 100% sure. Nor it is in the remote phase. Okay, so it is in between. It is probable that there will be an outflow of economic benefit. And the third is a reliable estimate can be made of the amount of the obligation. We cannot certainly define this much amount the entity may have to pay in the future, but we can reliably estimate it. Okay, if these three conditions satisfies, then we have to record provision in our financial statement. So now, see here, how can an entity reliably estimate the amount that we may have to pay? It can be done through past experience, quality and input, and statistical tools. Okay, these three are the basis of estimating the amount. So under the statistical tools, there are normal two techniques, that is expected value analysis and most likely outcome. In expected value analysis technique, normally in this technique is used in warranty provisions where large public is involved. Okay, so if any company is selling products to its large number of customers, consumers, then while selling the products, the warranty is also given, right? So in that case, how do we determine what amount of provisions should be booked in respect of that products? How do we determine how many products may go default? Okay, so in that case, we use expected value analysis, and the second one is most likely outcome. And this technique is used in a single case, that is, for example, court case. Okay, so suppose, for example, of the most likely outcome, suppose a person has filed a case against the entity for selling unhygienic products. So what would be the most likely outcome here? Yes, if is the company going to win the case or company going to lose the case? What is the higher percentage of happening? If the company is going to win the case, then they will certainly do have to pay the penalty. And if the company is going to win the case, then they may not have to pay the penalty. And If the higher chances that the company is going to lose the case, looking at the scenario, then the company will have to pay the penalty, and we can reliably estimate for what kind of situation, how many of penalty do we have to pay. So in that case, we reliably estimate through this technique. Okay. So now let's move on to the recording of the recognition of the provision, uh, the accounting treatment of when and how to make the provision in the financial statements. So here you can see the column. So there are 5 columns. Okay, I will go one by one. As you see in the column, there is present obligation, outflow of economic benefit, that is EB, and reliable estimate. Okay, and the treatment. Okay, so see in the first column, it says that the entity has the present obligation that it has to pay certain amount in near future, and the outflow of that economic benefit is probable. Okay, and the entity can also reliably estimate about what amount of penalty or expenses that the entity may have to incur. So in these 3 cases, these 3 cases indicate that it is a provision, and we should recognize provision in our financial statement. We should book provision in profit and loss. Okay, account. Okay. So in the second column, there is the present obligation. The outflow of economic benefit is also probable, but we cannot reliably estimate of the amount uh, at which the entity may have to pay, at what amount the entity may have to pay. So in this case, we cannot term it as provision because we cannot estimate it in figure. Okay, so in this case, we treat it as a contingent liability, which will be discussed later. And we disclose in respect of contingent liability, we disclose it in financial statement. And while we cannot reliably estimate, we disclose it in financial statement without financial effect because we do not have that data. Okay. So the next column, there is the present obligation that the economic outflow of economic benefit is going to happen in the future, and it is possible, and it can be reliably estimated also. But then also it is not a provision because the outflow of the degree of outflow of economic benefit is not probable like in previous case. It is in possible state. Okay, below probable. So since it is in possible state, we now have to disclose this also in financial statement as a contingent liability, but with financial effect, because we have reliably estimated the figure, right? So here we have to disclose it with financial effect. And lastly, if the outflow of the economic benefit is in remote, then we do nothing. Neither we recognize it as a provision, nor do we do make any disclosure. Okay. So so how do you determine in which cases, in which degree of certainty you denote it as it is a probable state, it is a possible state, it is remote, or it is partially certain? It has been given in the table. So for remote, it should be less than 10%. For possible, it should be in between 10% and 50%. For probable, it should be in between 50% and 90%. And for virtually certain, it should be above 90%. Okay. So now let's move on to the types of present obligation. There are 2 factors that will contribute towards the obligation of the organization, and that is legal obligation and constructive obligation. What is legal obligation? An obligation which is enforceable by law, that is legal obligation, and an obligation which is created on the basis of past practice, published policies, act, etc., is called constructive obligation, right? If the If the public has expectation of the entity because of the past practice, then it is termed as constructive obligation. Okay, so see the example of warranty. Well, in case of warranty of AC compressor, 5 years of warranty is the legal obligation set by the law, but 2 years of warranty given is the constructive obligation which has been given by the entity to the customer till date. So this creates a constructive obligation, okay? So now you can see the next heading, why IAS belongs to IAS 37. What is the significance of IAS launching IAS 37? Because the company previously used to make fake provisions and used to reverse it, okay? Because of this manipulation, the ISB launched IAS 37. So company used to do in this way that in case where the when the company is going through loss or not a good financial performance in that okay, so when the company goes through a good year, I mean when the company is making good profits, then at that time the company makes strict provision, okay, and when the company goes through a loss period, then they reverse that previously made provision and makes it an artificial gain, makes the gain in the income. So be so to stop this kind of manipulation, ISP has launched IS 37. So here we don't have to make provision. IS 37 had said that we don't have to make provision in case of self-insurance, in case of future operating losses. If there would be future operating losses, then there is no need to make, there is no obligation to make losses in future. Company may shut its operation in future and there is no obligation to recognize in today's financial statement, okay? And the next is future part replacement. So moving on to the types of provision, how do we record the provision? Do we record completely in day one, or do we record it in a spreading way over the years? There are three scenarios about it. Provision is dependent upon obligating events. There are three scenarios. In case of first one, in case of compulsory disposal cost or decommissioning liabilities, complete obligating event arises on day one. That is why complete provision is recognized on day one, because it is sure that those costs are happening in near future. So complete provision is recognized on day one. But in case of environmental provision, if there is if okay obligate if obligating event arises gradually, provision is recognized gradually over the period or life of the assets. That means because of the action of the entity, if there becomes any harm to the environment gradually, then only there is a need to recognize the provision. But it does not make, if it does not make any harm, then there is no need to make any provision, okay? So it happens like in a gradual, it goes like in a gradual procedure over the period. But there is but in case of environmental provision, if the company's past action has already harmed environment to the great extent and they have to pay a heavy penalty because of that, then in such case, complete provision is created immediately. We don't spread in that case. Complete provision is created immediately. Okay. Now the next topic is onerous contract. So what is the onerous contracts? So see here, onerous contracts are where the signed unassigned plus unavoidable cost of fulfilling the contracts outweighs the benefit that it will be received. So the excess of unavoidable cost should therefore be provided for in the financial statement. Okay. If the entity has already signed certain contract, thinking that this contract goes good, but later after signing, they finds out that the contract will not be beneficial to them, and the cost of signing the contract outweighs the benefits derived from that contract. But they find it later on, and they cannot cancel the contract, and the unavoidable cost that is to be incurred, it will be incurred in any way. So in this case, how it will be, how the provisions should be recorded. The provisions should be recorded. For example, the example of this scenario will be 2 years of non-cancelable lease recorded as leases. If we find out after getting to the lease agreement, if we find out that the lease is not going to benefit us, then at that time we will record the provision at the lower of penalty and present value of future rentals. Okay. If the penalty is lower, then obviously we'll cancel and give the penalty. But if your present value of futures rentals income that is lower, that will be lower than the penalty, then why do we give penalty and cancel? Then we go for the present value of future rentals. So the lower of these two will be recorded as a provision. So you can see the note here, no provisions to be booked for future fixed assets. Okay. If the company is thinking to buy a fixed assets in near future, then for that provisions need not to be booked. Okay. For that scenario, no provisions should be recognized. So moving on to the restructuring cost. What is restructuring cost? If the entity is going to make a big restructure, is going to incur a big restructuring cost in near future, then at that time the provision is required to be recognized. So when do we, how do we determine that yes, restructuring cost is going to be happen in near future? For that, some criteria are needed, and those criteria are one one is the detailed formal plan required by auditors. The detailed formal plan are seen by the auditors. The detailed formal plan are plans that have been approved by the BOD. The reasons had been stated why the restructuring is happening, an estimate of the cost or penalties and the time scales, the location of the people affected, and date of implementation. Okay, if all these are kept in a formal plan, then we can believe that yes, restructuring is going to happen in near future, and in that case we can recognize the provision. And the second one is there is there should be something that would create a valid expectation through expectation that restructuring is certainly going to happen in the future. That is with the help of announcement or by starting restructuring itself. So C creates valid expectation through announcement or by starting restructuring. That includes an announcement to those affected by the restructuring, and restructuring provision only for directly or attributable cost arising because of restructuring. If you have 20 rupees, then 20 rupees provision, not 40 rupees. Okay. Example, redundancy cost, penalties. And in second, no restructuring provision for ongoing cost, that is training cost or staff relocation cost. Okay, are you clear? When to recognize and when not? Which things are to be recognized as a restructuring cost and which are to be ignored. It is clearly written here. Please, you can note down the content for your future use. Now, the second heading of the standard is contingent liabilities or possible obligation. We have discussed that in above table also. What is contingent liabilities? Let's see. What is contingent liabilities or possible obligation? Let's read it out. Contingent liabilities is an obligation that arises from past events, okay, past events, and whose existence will only be confirmed by the occurrence or non-occurrence of one or more uncertain future events, and that is not wholly within the entity's control. Yes, it arises from the past events, the same criteria as of provision and liabilities. It arises because of the past event, but whose existence is not confirmed yet. And it will be confirmed by the occurrence or non-occurrence of one or more uncertain future events. And that also itself is not in the control of the entity. Okay. In this case, it is, we can term it as this scenario, we can term is as contingent liabilities or possible obligation, right? In for in provision, it is the probable obligation, but in contingent liabilities, it is possible obligation. Okay. So, what is the differences between provision and contingent liabilities? Provision is a probable obligation, but contingent liability is a very much uncertain liability whose recognition criteria is not met, like that of provision. So, therefore, we don't make any recognition or any entry in respect of contingent liabilities. Only disclosure is required. As I had explained in the table above, only disclosure in case of possible obligation, right? For example, the court case, the selling expired food products in the past. Okay. So you can see here again in the table, for remote, do nothing. If the degree of certainty is in remote, that is less than 10%, right? Do nothing. If it is possible, then disclose it in the financial statement. If it is probable, then record it as a provision. And if it is fairly certain, then this is a liability. Okay. If it is sure, then this is a liability. At this point, it is no more a contingent liability. Okay. So same like this, we can see here for contingent assets or possible assets. Previously, it was contingent liabilities or possible obligation, and now contingent assets or possible assets. So see, what is contingent assets? It is an asset that arises from past events. Okay, the same definition as of asset. Asset that arises of past events, but and whose existence will only be confirmed by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the controls of entity's control. The same as the contingent liability. Okay, results of the past event, but has not been confirmed yet and will only be confirmed by the occurrence or non-occurrence of one or more uncertain future events, and that is not within the control of entity. That is contingent assets or possible assets. For example, claiming insurance for fire due to smoking, infringement of the assessed. Okay. Okay. So spot the differences between the treatment of contingent liabilities and contingent assets. In contingent assessed, we do nothing with when the degree of certainty is remote or possible. Whereas in contingent liabilities, we would make disclosure when the degree of certainty was possible. But we don't do this disclosure even when the degree of certainty is possible in contingent liabilities. But and the rest, and if the degree of certainty is possible, then we make disclosure. At this time, we don't make record it as a provision. Okay, provision of assessed like that. In the case of probability, we make the disclosure, and if it is the virtually certain, then we recognize it as an assessed. Okay, so here it is given an entry for an example. Suppose there is a chance of receiving an insurance in near future, but it is not confirmed yet. You can go get more clarity if you look at this entry, P&L account debit and insurance receivable is credit. Below that, PL account debit with 1 lakh and insurance and provision to be credited at 1 lakh, and goes on like this. So that's the end of standard. So here is shown the examples of provision. What are the examples of provision? One is the warranty, as I have discussed above. Decommissioning liability or compulsory disposal cost that have been discussed. Environmental provision, restructuring cost, and onerous contracts. These all five are the provision. Okay, these all five are the provision, but there is a difference on how to recognize it. Would we recognize it in the financial statement by booking it in full in day one, or do we spread it in the over the years and towards the over the life of the assessed? Okay, so that's the end of the standard. The standard itself is not a very big standard, but yes, the questions have been asked in SBR many times from this standard in 25-mark question. So you have to be a very good clarity. You have to make yourself a very good clarity in this standard. I hope you are benefited with my lecture on this standard. If you find any difficulty or any defaults in my standard, my lectures, any mistakes in my lectures, which is getting you difficult to understand, then please do comment in my YouTube channel. And if it benefited you in any way, then please do not hesitate to share it. Thank you, guys. Have a good day.